Hello, I'm Troy Harmon, Chief Investment Officer, along with Nick Antonucci and Jacob Keene, our research analysts. This is your market update for December 2018 from Henssler Financial. Volatility, it's back.
Really kicked up in November, and despite everything, we had a positive return for November. In the first couple weeks of December, sell-off and volatility has continued. We're now down 5% in the last month, about even for the year on the S&P 500 on a total return basis.
Yeah, November was rough. Worst performing sector, information technology. It's quite a change from year-to-date numbers we had seen previously, but now information technology falls about 5th among the 11 sectors overall for year-to-date.
Yeah, you had GDP come in. We had our first revision
Right.
for third quarter GDP, down from, 4.2 in the second quarter.
It was, yep.
As we talked about, manufacturing and services sectors as measured by the ISM indexes still look strong.
Solid, yeah.
We had a jobs report last week, 155,000 jobs added to the economy, short of expectations for 198. So not a great report there. Unemployment held flat at 3.7%.
Still wage growth, though. I think 127,000 jobs have to be created in order to keep up with population growth.
Exactly.
So, it's kind of a bittersweet thing. Definitely weaker than we would have expected, though.
Yeah, absolutely. And wage growth did pick up 3.1%.
Yeah.
So starting to see some questions come into play whether or not the Fed's going to raise rates. We had inflation come in at, I think, 2.5% as measured by CPI. If you look at the PCEs, right at 2%. Oil prices have come down considerably. So that's going to put pressure on inflation to the downside, obviously, in the next reading. And
consumer still feels pretty healthy.
Yeah, retail sales look good. So the overall picture still appears to be pretty bright, generally speaking.
Yeah, let's talk a little more about that rate. Earlier, like a month ago, we were seeing a 77% probability of a rate increase. That's fallen a bit. We're around 70 now. Still, obviously, better than a coin flip. Market's expectations of a rate increase in December.
Sure.
I think it would probably be, this is my opinion, I think it would probably be a good time to pause. But the president has somewhat politicized that, which I regret.
Right.
And at the same time, I think a pause would be good. I truly fear that if we do see that rate increase in December, that we could see further inversion of the yield curve, which was talked about quite a bit last week.
Right, we saw, the 3 move above the 5. And if you look at rates as a whole, they're down, no?
They are, there. It's not just a story, purely on the rate side. I mean, if you look at credit as a whole, we've seen spreads widen. There's been some disruptions in credit overall. We're seeing some outflows in leveraged loans, high yields being pressured. And if you think about this cycle, I mean, there's been immense growth in credit. So that's, to me, the key risk moving forward. And I think that's kind of what's feeding into these reduced expectations for the Fed to keep the pedal to the metal as far as hiking, because it's starting to disrupt the bond market. I mean, you've got the 10-year yield coming off, but at the same time, you've got corporate yields moving higher.
Sure.
Yeah.
And that's kind of a point of concern when the next recession does come in. The previous one, it was very much consumers being levered, to the top, and this time it's corporations. All that debt has moved to the corporations' balance sheets.
This leverage is kind of feeding in some of the performance. One of the things we have talked about, guys, is if you look at price to earnings, it looks reasonable.
Mm-hmm. It does.
But if you look at price to sales, if you look at price to EBITDA,
some of the things that they can't engineer.
Right. These profit margins are higher, and this ability to borrow money to repurchase shares is kind of feeding on itself. If we get a reversal in that, it's going to have some knock-on implications moving forward.
And when you hear valuation talked about, you always hear it talked about on a PE basis. And even now that the market has pulled back as much as it has, if you turn on CNBC, valuations have come back, to a reasonable level. On a PE basis, maybe. But as you mentioned, on a price to sales, price to EBITDA measure, they still look very elevated.
Right. And I guess moving forward, I mean, kind of what we're talking about here is if the Fed does take a pause, I mean, that's moving your discount rates down.
Mm-hmm.
I mean, if we're valuing cash flows, I mean,
Sure.
it does make equities, more attractive. So
Right.
we could see that kind of as the story moving into 2019. But I think overall, we kind of do feel like we're late cycle here, and expected returns, we're probably not going to hit that 10% average that we've seen. It's probably going to be a good bit lower than that.
Yeah,
Yeah.
expect volatility to persist. You've got kind of one-off events such as concerns over the trade war. As you've seen over the past couple of weeks, one night it looks like we might move closer to a deal. The next day, it's the complete opposite. And we had the requested arrest of the Huawei CFO, and that kind of threw markets into negative territory the following day. So expect volatility to persist, I think.
I think this is the time that you want to really think about what is the quality of the stocks that you own.
Yeah.
High quality is going to start standing out when you start to see, these growth expectations move lower, these concerns about credit, increase in the minds of investors.
Yeah. All right, well, that's probably a good place to end it. Jacob, I totally agree with you. We're late cycle. It feels like a very late cycle. Nick, the point you made about staying conservative, I think is still a great idea. I don't look at this as any imminent buying opportunity. So, as far as investors go, conservative, high-quality stocks are where to be right now. So that's your market update for 2018 December. Thank you for watching.